Welcome back, everyone. We have an exciting day today. First of all, the market's in the green, something we haven't seen for a while. But this does make sense because today a lot of companies are reporting earnings and they're overwhelmingly good. They're beating earnings. A lot of companies are doing surprisingly well. And we've seen that with ones that we're going to be covering in this episode. Now, there's a couple companies that have just recently reported earnings, and I have the actual earnings report up. One of them is Coca Cola. Coca Cola, they just crushed it. It was way better than expected. Now, I thought the company would do okay, but again, this was really good. We're going to be diving into the numbers here, looking at more insight from this company. I've also been waiting to go over Netflix's earnings report, and we have the official report here, as well as all of the numbers in Qualtrim. So we're going to be looking at Netflix and what this company's been up to, what they're forecasting, and why I own $36,000 worth of Netflix stock. This is a massive holding for me, and I did that intentionally because I feel so positive about this company. This earnings report further validates how I feel. And then we also have an earnings report from another streaming company, this time Spotify, which I have to be honest here. I was a little bit surprised by Spotify's earnings report. I was a little bit caught off guard. They made money. Now, they didn't just make diluted money where they're printing off shares and they're generating fake cash flows. No, this company made real money, over $100 million in this quarter. This was a great quarter for Spotify as well. A little bit shocking, but I love to see it. Spotify is a company that I love the product. I'm really hoping this one does well. And this is the first earnings report that I think has breathed a lot of life into the story of Spotify, into this company actually producing real money. So we're going to be going over in depth all three of these earnings reports. Obviously, we have a lot to get into, so let's go ahead and jump right in. Now let's go ahead and start off here with Coca Cola. We have here a note from Qualtrim saying that Coca Cola shares are trading higher after the company reported better than expected Q3 financial results and raised full year guidance. Coca Cola is up almost 3% on the day. Now, the company's had a tough year with a lot of consumer packaged goods companies, a lot of these defensive companies. We know the 10-year treasury going up doesn't help this stock. And then there's also the big concern of Ozempic. There's a lot of investors really convinced that Ozempic is going to be a big problem for these companies down the road. Because simply put, what Ozempic does is it makes people have a lesser appetite. It makes them feel fuller for longer. So the idea behind the drug is that you crave sweet products, candies and snacks and different salty foods or sweets like Coca-Cola, you crave those products less. So this has been a little bit of an overhang on the stock. Now, we'll get into that more a little bit later, but I want to look at the actual numbers here to see what's actually happened over the past 3 months. Coca-Cola reports the third quarter 2023 results. This is just this morning. Global units increased 2%. Now, at first glance, 2% doesn't seem like a lot, but keep in mind, Coca-Cola is a very mature company. It's everywhere. The fact that they're growing unit volume, meaning they're not just increasing prices. That's not price increase. That's them selling more stuff to more people. That is a hugely positive thing. You'd expect companies with any type of slowdown or any type of halting to have unit growth that's either 0% or even in the negative. A lot of consumer packaged companies have had negative unit growth, meaning they're selling less products. Now, not only are they growing in unit count, they're also increasing prices. Coca-Cola doesn't like to say they have tons of pricing power, but they do have pricing power. You can see that because their total net revenues grew 11%. Organic revenue, the same sales, grew 11%. So 8% growth and 11% growth in revenue. That's great. Company this mature growing 11% organic revenue, that is really good. So this is a beat on the top line. It's a beat on the bottom line. They're growing unit volume. They're also increasing prices clearly because their revenue is growing faster than their unit growth. Their operating income grew 6%, and then their operating margin for the quarter was 27.4%, basically in line year over year. Now, if we look at Coca-Cola, we can see how their operating margins look over time. Let's bring up that chart here. Let's go down to ratios, and then we'll go to operating margin here. And you can see right here, this is the 20% mark. So Coca-Cola over the past 5 years, since 2018, they've increased their operating margins. How did they do that? Well, part of what they've done strategically over time is they've gotten rid of a lot of low margin parts of their business. So the bottling and different things that are higher capex, They've gotten rid of that and they focused on the very high margin stuff, which is basically selling their recipe. So they're like a brand company selling their recipe, causing operating margins, gross margins, and profit margins to go up. But right here, we have 27% operating margins. Looks very strong for the company. They also go into free cash flow here. This was $7.9 billion, an increase of $636 million in the prior year. So operating cash flow, free cash flow, both going up incrementally, something that I love to see in this report. Now, of course, we also have the question of Ozempic, and this was something that James Quincey, the CEO of Coca Cola, was asked today on CNBC. What does he think of Ozempic? Is it going to impact Coca Cola? Are they modeling it? Is there any risks associated with it to their company's earnings? What are their thoughts? And James Quincey, the CEO, basically said that right now they see no data of Ozempic impacting Coca-Cola sales. And even if Ozempic grows in the future and more people use it, which he says is highly speculative and there's lots of models that don't make sense about Ozempic, but even if it does become a more popular thing, Coca-Cola offers zero-calorie versions of almost every drink they sell. So you can buy zero-calorie Coca-Cola or Sprite or anything. They have calorie light versions of almost every product. So they say if there's a segment of their consumer that's very calorie cautious, but also wants flavored drinks, they offer a product for that consumer. So in terms of Coca-Cola overall, this report was very strong. The company's in a very strong position. I like what they've done over the past couple of years. I also like the advancements that they've done with their Coca-Cola freestyle machines. These machines where you can pick out which drinks you want. They're genius, and you see them in lots of food companies now. This company really is just, it's keeping up. They're executing well. They're doing a good job. It's a mature company, a slower growing one, but one that I think is very solid, very defensive. Great report from Coca-Cola. Now, next up, we have Netflix, which reported earnings last week, and the stock reacted by going up 16% after hours. A 16% jump in price, which is crazy, and it held on to it. Over the past week, in fact, it's up almost 19%. So it's gained a ton back, and Netflix continues to make gains. Even today, it's up a decent amount. Let's go ahead and take a look at the actual letter and see if these moves are justified. Now, on the top of every earnings report, Netflix has a lot of highlights here, and I think they're really good highlights. So I'm just going to go through some of the biggest ones here. They say our Q3 financials were in line with to or ahead of the forecast with revenue of $8.5 billion. Paid net ads of 9 million and operating margins of 22.4. Okay, big thing right here. Paid net ads of 9 million. Now, paid net ads means out of how many people they lost that canceled and how many people they gained, this is the net between the two. They gained 9 million subscribers in the quarter. 9 million. And this is after Netflix is supposed to be dead and it's supposed to be, all the predictions of HBO Max and Disney and they can't keep up with YouTube. They just gained 9 million subscribers. This is over double what people were expecting. They're expecting 5 or 6 million. So another 3 or 4 million subscribers on top of that. And then on top of that, they also had operating margins on the very high end of their guidance range, 22.4. So we have huge gains in net adds of subscribers, great operating margins. They continue on saying, we now expect the financial year of 2023's free cash flow to be $6.5 billion, up from our prior forecast of at least $5 billion. We repurchased 2.5 billion shares in Q3 and increased our buyback authorization to 10 billion. So this is something that a lot of investors are having a difficult time wrapping their heads around. That Netflix is a profitable company. Now, it's not just a company squeaking by, barely making profits. Netflix is a highly profitable company, a cash flow generating machine. This company bought back 2.5 billion shares in the quarter. They're generating 6.5 billion in free cash flow this year. A couple years ago, I made the prediction that in 2025, Netflix would have around $10 billion in free cash flow. People called me crazy at the time because a couple years ago, Netflix wasn't generating free cash flow. How can a company go from generating minus $3 billion in free cash flow to positive $10 billion? How can that happen in only a couple years? Well, Netflix is pulling it off. They're doing just that. They're generating $6.5 billion. Now, some people will criticize and say this is just because of the actor strike. That does play an impact. They are spending less money on content than they would otherwise, but that impact is only about $1.5 billion. So the majority of this cash flow gain is not from the writers or actors strike. This is from Netflix growing, having better operations, and a more efficient company. Their margins are going up, increasing their free cash flow. And this is a huge indication of a company that has a lot of operating leverage. Now they continue on saying that they're improving their content slate with best-in-class originals and licensed content. Netflix has that dual strategy of taking random series like Suits and breathing new life into it. Suits became a blockbuster hit again for a series that's, I think it's over 12 years old now. It came out in like 2011 or something like that. And it was a huge hit because Netflix knows how to get shows in front of people and make them interesting again. But they also have a lot of original content that's brand new. They're getting a lot of good feedback on that. And then we have the other big question. Adoption of our ads plan continues to grow. This was a big question mark for Wall Street. And this continues the game of Netflix playing whack-a-mole with Wall Street. This game of whack-a-mole has gone on for a long time. It started off with in 2020, the lockdowns and people signing up for Netflix caused a huge outsized growth in Netflix subscribers. Then 2 years later, Netflix started to lose a couple subscribers, a couple million, which was less than 1% of their total subscriber base. But that created a question mark. Is Netflix done growing? There was HBO Max and Disney Plus, and Netflix was supposedly done. Their growth was behind them. The better days were behind them. Netflix answered that question. They continued to grow by adding more than 15 million subscribers. Then the next question happened. Netflix was doing a password crackdown. The big question mark there was, will it be successful? Will people end up just canceling Netflix? I showed on this channel the math behind it and how the password crackdown was overwhelmingly in Netflix's advantage. They had the math behind them. If a family of 4 was sharing a password, odds are there's going to be at least one person that's willing to pay, more likely 2 or 3. So of course that was a resounding success, and Wall Street looks like fools by questioning in hindsight. Then we have the next question. The next big question is the ads plan. Will Netflix be successful in launching an ad tier? Well, right here we have the actual data, with ads plan membership up almost 70% quarter over quarter. So they're seeing a sequential growth in a 3-month period over a 3-month period of 70% uptick in the ads plan. And they say 30% of signups in our ad countries are, on average, to our ads plan. So 3 out of 10 people that sign up are picking the ads plan now, which is a very high average revenue per month. They say our $6.99 per month plan in the US continues to support our ads plan growth. So people pay around $7 a month. They see around, I think it's 4 minutes of ads per hour of content, which equates to around $15 or $16 of revenue per month for Netflix. So the majority of their revenue actually comes from the ads, not from them paying $7. But both of them work together to get that average monthly revenue. So just to go over some of the highlights here. Netflix is growing in revenue. They're growing in margins. So margins going up, revenue going up. They're growing in the amount of users way above expectations. So we have volume growth in users on top of price increases, on top of margins going up. They're growing in free cash flow. They're doing more buybacks than expected. They're increasing their authorization of future buybacks. They're also investing into their content slate, and they're growing in their ads plan, which is very accretive to their overall revenue. That's what we've seen so far with the highlights. And this gets better. The report doesn't get worse. When you dive in even past the highlights, there's no dirty secrets in this report. There's nothing that I can find that's a striking red flag. Every single thing is moving in the right direction for Netflix. You might look at dilution, but even right here, the amount of shares went down quarter over quarter from 451.6 million to 450. So they're not diluting you, the shareholder, they're actually buying back shares. And then when we look at Netflix and we compare the amount of free cash flow to stock-based comp, we can look at this on the most recent quarter here. Last quarter, they generated $1.89 billion of free cash flow, and they spent $79 million on stock-based comp. So this company is a highly efficient company in terms of their free cash flow compared to stock-based comp. They're not diluting the shareholder to pay all of their employees. Now, of course, what we've looked at so far is what's already happened. What's happened in the past 3 months? But that leaves the question, what's going to happen in the next 3 months or in the next year? This is where we get into their forecast. They say right in their forecast, Our goal is to accelerate revenue growth, expand operating margin, and deliver growing free cash flow. All goals that I 100% agree with. I'd love to see all of these. They say that we forecast revenue of $8.7 billion, up 11% or 12% on a currency neutral basis. That means that Netflix is back to double-digit top-line growth, double-digit revenue growth, which is great to see. They say for the fourth quarter, we expect paid net additions to be similar to Q3's 2023, plus or minus a few million. So to get this right, if I'm understanding this, unless I'm reading this incorrectly, they gained 9 million subscribers just this most recent quarter, and they're saying that the next quarter is going to be similar. They're going to gain 9 million plus or minus a few million. That is incredible. That is this is an aggressive guide. They are really saying that they're growing, double-digit revenue growth, and they're going to gain another 9 million plus or minus a few million subscribers. That is very strong. For a company that people were talking about like it's not growing, Netflix sure seems to be on a very strong growth path. They say the global average revenue is expected to be roughly flat, primarily due to limited price increases over the last 8 months. That makes sense. They say that the strength in dollar is going to be a $200 million expected drag on Q4 revenue. Keep in mind that Netflix gets most of their revenue, over 50%, outside of the US. So exchange rates has a huge impact on them. Now, they also say in their guidance that they're updating their operating margin guidance to forecast 20%. So they're guiding higher in their margins. Now, Netflix continues on talking about engagement and watch time and top viewed films and the type of content they're creating internationally and their expansive plans with video games and on and on and on. They have a lot of ambitions. But the bottom line is, with this report, even if you try to nitpick it, this was a great report. They're growing well above expectations. They are doing buybacks. They're highly profitable. They're a company that has a product that people are obviously addicted to. And I think the market is still misunderstanding it. Wall Street has continually been wrong year after year after year with Netflix's free cash flow. They haven't even been close. In 2022, Wall Street was off by a full $1 billion. This year, it looks like they're going to be off on $3 billion. So Netflix is still to date misunderstood. They're a company that the analysts continually get wrong, and I see further upside in the stock. So in terms of my $36,000 investment in the company, right now I feel totally comfortable in it. I get a lot of people are still antsy about the valuation and what's going to pan out over the next year. But what I see fundamentally with this company is a lot of strength. And so right now, I'm going to continue to hold. Now, finally, we get to Spotify, which also reported earnings this morning. And as you can see, it's up almost 9% after hours. Now, again, I don't like to look at the immediate stock price reaction to be a huge indication of how the company's doing. But in this case, it's another one where I think the move here is warranted. We have a note here from Qualtrim that the shares are trading higher because premium revenue grew 10% year over year and total monthly active users rose 26%. But I also think there's more to it than that. Let's go ahead and take a look at their deck here. Now, Spotify does a good job of making a really glossy presentation. Don't let that influence you when you're looking at companies. If the presentation is super glossy, don't judge it any better than one that's really archaic. What really matters is the numbers. So let's go ahead and take a look at the actual numbers here. The second largest Q3 for monthly active users and net additions was continued subscriber outperformance. Now, I will say that this part did not surprise me, because what have I been saying over the past 2 weeks? I agree with Steve Eisman's assessment that right now consumers are pulling back on big ticket financed items. People don't want to buy cars right now. They don't want to buy solar panels. They don't want to buy homes. So realtors are seeing a slowdown in business. Solar sales are slowing down. Companies are having a very tough time. And of course, the auto market's having a bit of a slowdown and a pullback from a couple years ago. But small ticket items, restaurants, Coca Cola, Spotify, Netflix, these little charges people can still afford, and people are still employed. If you're employed, you're going to be able to afford Spotify. There's no problems there. They gained in monthly active users. They gained in premium subscribers. Their total revenue grew 11%. So really good growth of the revenue. And then margins actually went up to 26.4%, up 166 basis points, which means that margins went up like 1.6%. That's great for the margins. Now, this is all good, but the big problem with Spotify, the big gripe I've had, is that they put these nice numbers in front of you, and it never translates into profits. And if you have a company that's growing in users, growing in revenue, but they can never turn a profit, to me, that's just not a good sign. I want companies that can make good profits with their growth. I want companies like Netflix that are churning out free cash flow. Companies like Visa and MasterCard churning out free cash flow. This has always been the problem with Spotify. So what I've looked for in this report is the actual cash flow statement here. So let's skip past a lot of the stuff where they show their top line growth. Let's go down to the actual cash flows here. Now, right here, again, a very glossy statement. Spotify is really good with the UI and their design. And they basically say that they're building a sustainable business, a sustainable balance sheet. But this is where they leave out that pesky stock-based compensation. So you do not get the full picture here. And so far, free cash flow almost always is below the amount of stock-based compensation they have, which means they're still diluting you as a shareholder. To get to the actual numbers, we need to skip down further. We need to get to that cash flow statement. Okay, so here's the cash flow statement. Sheesh, this is a really wide spreadsheet, so you probably won't be able to see it, but I'll highlight the important numbers here. What we have is net cash flows from operating activity. This was last quarter, which was $211 million. Now that is a massive increase over past quarters. So September 30th, 2022, it was 40 million. June 30th, 2023, it was 13 million. It jumped to 211 million. A lot of operating leverage. This business is showing something good here. Share-based compensation expense of 85 million, which is actually down over time. And then if we look at the actual purchase of property and equipment, they have virtually none. They never have any quarters, so there's really no CapEx. They probably bury that with other expenses like AWS or something. But what we see here is a company that basically has $211 million of operating cash flow. They have share-based expense of 85 million, which means that this quarter, Spotify generated a real free cash flow, stock-based comp adjusted, of $125 million. That's real money. There's no gimmicks played here. They are really profitable this quarter by over $120 million. Now again, this has so far been my big gripe for Spotify. Their inability to turn revenue and user growth and the top line growth and translate that into profits. But this quarter, they did that. They translated it into profits. So overall, I like what I'm seeing with these earnings reports. All three of these were very strong. And I'm seeing a consistent trend of companies that offer cheap, affordable products that offer a lot of value or entertainment to customers. They're doing really well right now. So I like what I'm seeing with these trends. I think this earnings season is doing really well. It's off to a great start, and we'll see what happens later this week. Make sure you subscribe to see more content like this in the future.